Every wealthy nation that tried to tax fortunes directly ended up abandoning it, and the reason reveals why the system protects itself. Between the 1950s and 1990s, 12 European countries implemented wealth taxes. France, Sweden, Austria, Denmark, Germany, all of them. Each one promised to fund public services and reduce inequality. Each one failed. By 2017, only 3 remained. This wasn't accident. It was predictable collapse baked into the design. Exhibit 1, France's wealth tax, introduced in 1989, collected roughly 0.3% of government revenue while costing millions to administer. The wealthy didn't disappear their assets, they disappeared themselves. Capital flight became the rational response. Accountants in Luxembourg and Switzerland suddenly got very busy. Exhibit 2, compliance costs exploded. Wealthy individuals needed teams of lawyers and appraisers to value art collections, private businesses, and real estate. The government needed matching expertise to audit them. You're paying bureaucrats to fight accountants in an arms race where the wealthy have deeper pockets. Exhibit 3, valuation became the weapon. How do you tax a family business worth billions if there's no liquid market for it? Force a sale, that destroys the business. Allow a discount, the wealthy exploit it. Either way, the system grinds to a halt under its own contradictions. Modern proposals, like those debated in the United States and parts of Europe in recent years, promise to solve these old problems with new technology: digital asset tracking, coordinated international enforcement, higher audit budgets. But they're addressing symptoms, not the fundamental feedback loop. The loop works like this: wealth concentrates because it compounds. Once concentrated, it buys political influence. That influence shapes tax code to protect itself. Wealthier people move assets to avoid the tax, shrinking the base and forcing higher rates on the remaining taxable wealth, which accelerates avoidance. The system collapses not from incompetence, but from its own internal logic. So wealth taxes fail because they ignore a hard truth. You can't tax capital that moves. You can't value assets without markets. And you can't enforce rules that those subject to them can afford to circumvent. Every nation that tried learned this the same way, through expensive failure. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for more breakdowns of how wealth systems actually work, not how they're supposed to work. Subscribe to keep uncovering how the rules of wealth actually work, not the version they tell you in school. This video is for educational and informational purposes only and is not financial advice. Always do your own research.